Hello and welcome to 5-Year Club video number 346. At least I think it's 346. YouTube. Let's see. Yep, 346. There we go. All right. Tonight is all about what is a bear market. We haven't had one in so long that I think some of the younger people who find this video someday will say, I'm not exactly sure what that means. So let's listen. Because they will refer to themselves in the plural. Nah, I don't need that. I should just throw it away. All right. It's a cover for this little LED light on the front of the mic because I don't like little LED lights. All right. Invest during a bear market and you may be in for quite the rocky ride. During bear market periods, investing can be risky even for the most seasoned of investors. A bear market is a period marked with falling stock prices. In a bear market, investor confidence is extremely low. Many investors opt to sell off their stocks during a bear market for fear of further losses, thus fueling a vicious cycle of negativity. Although the financial implications of bear markets can vary, typically bear markets are marked by a 20% downturn or more in stock prices over at least a 2-month time frame. Bear market phases. Bear markets typically begin when investor confidence begins to wane following a period of more favorable stock prices. As investors grow increasingly pessimistic about the state of the market, they tend to sell off their investments in order to avoid losing money from the falling stock prices they anticipate. This behavior can cause widespread panic, and when it does, stock prices can plummet. When this happens, trading activity tends to decrease, as do dividend yields. At some point during a bear market, investors will typically try to capitalize on low stock prices by reinvesting in the market. As trading activity increases and investor confidence begins to grow, a bear market can eventually transition to a bull market. Origin of term. The term bear market is named for the manner in which a bear attacks. The manner in which bears tend to attack. A bear will usually swipe its paws in a downward motion upon its prey, and for this reason, markets laden with falling stock prices are called bear markets. Bear market versus a bull market. A bull market is one marked with strong investor confidence and optimism. It is the opposite of a bear market during which negativity prevails. In a bull market, stock prices go up. Like the term bear market, the term bull market is derived from the way a bull attacks its prey. Because bulls tend to charge with their horns thrusting upward into the air, periods of rising stock prices are called bull markets. Unfortunately for investors, bull markets that last too long can give way to bear markets. Bear market versus market correction. A market correction is a period in which stock prices drop following a period of higher prices. The idea behind a correction is that because prices rose higher than they should have, falling prices serve the purpose of correcting the situation. One major difference between a bear market and a market correction is the extent to which prices fall. Bear markets occur when stock prices drop 20% or more, whereas corrections typically involve price drops around 10%. Furthermore, market corrections tend to last less than 2 months, whereas bear markets last 2 months or longer. So for perspective, we dropped about 15% from the peak if you're looking at the VTI, Vanguard Total Market Index. And it has been falling mainly in actually October, November, and December. I think it was falling in October too. So yeah, that's more than 2 months, but we're not at the 20% mark yet. So it's kind of vague, but I do hear a lot of negativity in the news for what it's worth. People are very worried about recession in 2019, and that's also reflected in the yield, the bond yields, the Treasury bond yields coming closer together and almost inverting the 2-year and the 10-year note. Also got a video about that. All right, statistics. Between 1900 and 2013, there were 123 market corrections and 32 bear market periods. During this time, the average market correction lasted 10 months, while the average bear market lasted 15 months. You know, it said the average market correction lasted 10 months. Maybe that's where it's not that the market is falling for 10 months, it's that the market stays down for 10 months. Bear markets are usually shorter than bull markets, which can bode well for investors. Oh boy, okay, well there you go. If the market falls 20%, especially if it does it very quickly, then that is known as a bear market. If it falls a little bit less, that is known as a correction. And for sure, you know, there will be bear markets in our future if this current stock market activity is not a bear market. So, you know, prepare your investment mind to deal with a bear market, right? Since people can't predict them, you need to be prepared to stay invested in whatever your current asset allocation is throughout a bear market. And if you're not ready to do that, then perhaps your current asset allocation is not the right one. All right, well, that is it for video number 346. I hope you enjoyed it. Have a fabulous evening.